Ladies and gentlemen, good morning. Let us very quickly review what happened last week with our usual starting point, and that is the euro dollar, the shortest end of the curve. Well, not a lot happened. We only ended up 3 or 4 basis points, so the front end of the curve stayed relatively stable. But what is striking is that it didn't rally a single basis point on the back of the fall in the in the equities. The 2-year note equally had a mildly bearish tone and ended towards the lows, but still above the very important support at 109 that we indicated for a couple of weeks. The 5-year note ended up slightly higher in yield and is going to test the 200-day moving average at the 130 level in terms of yield. So it's definitely moving higher, but as you can see, the targets and the bearishness is greater the further down we move down the curve. And here we have the 10-year note yield, which is at the moment at 167, having broken decisively above the previous high, which was at 164. Then it tried the downside and finally gave up the ghost and is going up. This is the important level that we have at 169, 170. A break of that would see us definitely bust the downtrend and go towards the 180 area or even 190, which is higher than the Brexit high before the plunge in yields. We are now in the 10-year note almost back to pre-Brexit levels, which we think is very significant. In terms of IEF, which is the closest proxy for the 10-year note in ETF land, we have a decisive break as well. If next week we bust this uptrend line, we think we are definitely going to go and trade 110. So there's so that's another decent fall for the 10-year note. And the 30-year note is actually the most bearish of them all. This is TLT in ETFs, which has room to go all the way to 132, having decisively bust through the level that we've been indicating, which is 137. Having bust through 137, we think it probably trades 132 or slightly lower in the next few days ahead. Again, this is going straight back to pre-Brexit levels. This is the Brexit low at 132 when the market was anticipating no Brexit. So what the yields are telling us is the yield curve is steepening dramatically. All the flattening that came post-Brexit is being taken out of the market, and the market is going straight back to pre-Brexit levels. That has implications for many other asset classes, and we shall go through those in a moment. Yield in 30-year notes, well, we could easily test the 2.5% level, very close to the moving average, which is coming down at 258. So 250, 260 could easily be seen in the next few days in terms of 30-year notes, 30-year bonds. So we have a decisive steepening of the yield curve. The market has decided that bonds will not wait for more QE, but they will start a decisive new leg higher. But this still does not break the 30-year downtrend line, which is higher than that. This is the first wave that we're going to see, followed by consolidation, and then we decide on the next big move, which we think is going to be higher. What of European yields? Well, the Bund has made a decisive break and is now in positive territory for the first time in several months. This to us indicates that we will go and test probably the 10 basis points level, which was the pre-Brexit high. We still cannot get bearish of bunds. Why? Because they have an implicit Deutschmark call embedded in them. If the euro were ever to fall apart, the anybody owning bunds would get Deutschmarks. And therefore we think that the bearishness in the bund market is going to be short-lived, and there will be huge support at the 10 basis points to maybe 12 to 14 basis points area. We just cannot get bearish of this market at these levels because we know that if a panic starts in Europe again and towards the Italian referendum, which now could be in December, we will be in negative interest rates and hugely negative interest rates. These lows will not hold it. So we cannot get bearish of the Bund. We like the Bund at around the 10 to 12 basis points area. We don't think it'll break it. We certainly don't think it'll break the 20 basis points area, and that is where we say that we are wrong in our view. The Italian bond, on the other hand, is a completely different kettle of fish. The break of this previous high in yields, which was around the 118, 119 level, invites a test of the pre-Brexit low, which was approximately around the 150 area. That is a 25 basis points move in the Italian bond as opposed to a 6 to 7 basis point move in the Bund, and you can see why we think being long of bunds and short of BTPs is a great idea, and we shall definitely be adding to it quite heavily next week if the idea starts working truly in P&L terms. The Italian bond has the opposite option embedded in it, i.e. that you get paid back in liras. And we think that the move that we get from this market is going to be pretty dramatic. You can see in terms of weeklies, it's not a very good chart, that we could go all the way back to 2% without very much, without any great difficulty. If we get to the 140, 150 area and we go through it, we could easily break all the way back up to 2%. Now, it certainly makes sense to us that Italy should be trading at a higher yield than the US. And therefore the move here we expect to be very dramatic. We just are unapologetically bearish for the Italian market. Where does that leave us in terms of equities? Well, we've been saying for a long time that the bond market and the equity market are more or less joined at the hip. The high valuations in equities are supported by high valuations in bonds. If bonds now retreat to pre-Brexit levels, it is logical that the market is going to fall to around normal retracement levels. What is a normal retracement level? Well, certainly around the 2100 to 2075 area in the S&P, and that is actually supported by the current level of the VXX, which we think might go all the way to at least 42 and quite possibly even 48. The daily chart is certainly not overbought. A volatility panic could easily get it up towards the 42 and 47 areas. That is actually supported by the very bearish move that XIV made on Friday, and we would not in the slightest be surprised to see the 32 area to even 30 and a half area be tested in the next few days, quite possibly next week. So we unfortunately are bearish for the for next week for the equity markets, although we are left long because of our option position, which we will have to rectify first thing on Monday. We don't think it's going to be naturally a straight line, but it could be quite a rapid move, say by midweek, testing the 200 period moving average in XIV and VXX. The chart of ES supports that, and on a daily basis, we think that it cannot be excluded that the market tests somewhere very close to the 200-day moving average, which is just above 2050. We do not expect the market to break it and go lower. We are bearish for 40-50 basis points. We're not bearish for 100. So we will definitely be covering any shorts that we might establish somewhere around the 2075 to 2060 area, and then start to looking up for the final wave higher. Our bearish view in equities in the States is actually reinforced by the IWM ETF. We think it could easily come down and test below the 200 period moving average, which is somewhere around the 117 to 118 area. We think that might be a good buying opportunity for a 3 to 4 point upside move, but certainly the first move of the week we see as deeply negative, then followed by another move higher towards the 120 area or to 121, and then we can see where we go from there. But we will definitely be selling from the open for a move down towards this trend line in IWF, and since that has been leading the market higher, we think that that will probably be the market which has the highest chance of retracing properly. If we just mark a normal retracement pattern, that will give us an area, as we indicated, somewhere between 116 and 118 that will be tested early next week. Moving on to European equities, we have quite a bearish setup. We have the this is the Stoxx 50. We are very thankful that we are out of all our longs. We could now easily go down towards the 2,950 area, which is 100 points lower than we closed, which is approximately 3%. If we say that a 3% move in European equities, the equivalent to about 1.5 to 2% in the States, that would actually give us the 2075 area in S&Ps that we have been talking about as a potential first target to the downside, and where we should be looking to get long for a move back up towards the 2125, 2150 area retest, and then we make our mind up where we go. We will definitely be shorting the European equities. We see very little upside for those now that the bond market in Europe has decided to make a decisive move lower. Much the same can be seen in a chart of DAX, as soon as it breaks the 10,500 area, it will just open a very nasty drop all the way to possibly retest this trend line, which would be normal, and that level would come around the 10,200 area, maybe even 10,100 area. And that is the level that we would be looking to buy for the next move higher. So we are overall not bearish equities. We are far less bearish equities than we are bonds. This is the first move. This is the asset contagion that you always get on the first sharp move in the fixed income market. People start panicking and dumping everything they have, which it is justified for the next few days, but is not justified long term. The steepness of the yield curve is an indicator of several things. The first is no more QE, or the market not expecting much more QE, which is bearish for equities, but also it's an indicator that we are normalizing. If we're normalizing, then the chances that the economy will not go into recession is actually higher than it was before. So it's equity positive from that respect, and therefore it is actually a longer term bullish implied event for equities as opposed to bonds. What of the dollar? Well, all yield curves are steepening, therefore it's a dollar neutral event, and this is what you saw last week. Up and down trading. We still are completely stuck between the huge support we have at around the 94 area and the very strong resistance we've had all year around between 96.5 and 97. So we very much doubt that the volatility will be in currencies. We think the volatility is going to be in fixed income and in equities. We will be leaving foreign exchange well alone, apart from one currency, which makes now fundamental sense, and that is the New Zealand dollar. Every time you have substantial moves in asset classes, you have the New Zealand dollar acts like a risk on, risk off currency. We now are probably in a period of risk off, and we would expect the New Zealand dollar, after maybe some indecision around the 74 area, to roll over significantly and come and test at least the 200-day moving average, which is around the 69 area. So we will keep on doing this trade until we lose a lot more money than we have so far. We just think that the timing is right for the New Zealand dollar to start giving up the ghost. It is falling, all the bricks are falling into place. The yield curve is steepening. The equity market is in a risk-off period as a result, which will naturally change eventually, and that will make the New Zealand dollar give up the ghost and go and retest at least the bottom of this up channel. We are going to be sellers of the New Zealand dollar all the way up to 74, 74 and a half, and with a stop above 75. It's quite clear that if it trades above 75, we are wrong. But we really think the risk reward now for the New Zealand dollar is sharply lower, at least 3 to 4%, while other currencies do very much nothing at all. Everything we have said so far about the 17 times forward earnings multiple Blue Angel line is proving correct. The market just cannot bust above it, and in times of huge uncertainty, what does the market do? It goes back to the 16 area moving average for support, and that does come up somewhere around just over 2050, maybe 2070 in the S&Ps. So that is what we are expecting the market to do, and bounce significantly from there, probably all the way back to very close to the 17 times line, much the same as this kind of price action in this area here. We certainly don't expect it to trade for any length of time below the 16 time moving average. What biases does that give us for next week? Well, we are going to be again buyers of bunds around the 10 to 12 basis points areas we indicated, with a stop above 15 basis points. The BTP we're going to continue selling, as we have a target which is nearly 25 basis points away, an immediate target. A break above 130 will actually accelerate the trend, and we want to get short before it. The New Zealand dollar, as we implied, we will sell between 74 and 74 and a half, with a stop above 75, looking for 71 or 70, a minimum for the first wave. ES value longs around the 2075 area, with a stop below 2060. Any rally up towards the 2150 area we will be looking to short quite heavily. And gold, which we haven't mentioned so far, we see a decent possibility that it will trade now all the way down to 1235, 1255. Let's have a very quick peek at this chart. Well, it's tried the 1360, 1370 area so many times and failed. In some people might say that in a period of risk off, gold is going to be the natural refuge. Well, we doubt it. We think that the higher yields are actually going to prompt people to liquidate gold positions to move into fixed income. We think that is ultimately the wrong thing to do, but we don't think, we would not be at all surprised if we manage to break this trend line sometime next week and tumble all the way down to test the 200-day moving average. Don't forget that if all the markets are actually moving to the pre-Brexit levels, gold on Brexit day, well, we remember buying it at 1280, and that was about here. But on the day of Brexit, gold was actually trading 1260 in the morning. So we think there is a very good level that gold now gives up the ghost, and we have a decent risk reward because we have a natural stop here above 1355, or if you want to be extremely careful, above 1370. 1370 breaks, you know you are way wrong. So selling 1330 with a 40-point stop and a target around the call it 2040, 2050 is actually not a bad risk reward. So that is a trade also to consider. Just a few words of emphasis about certain markets. This kind of move on Friday, which we certainly didn't expect, we certainly expected it to hold the Bollinger Bands, is actually not a move to be faded. Any move, for example, in IWM towards the top of the Bollinger, in fact, towards where the Bollinger Band was, around the 122 area, we will be trying to short. The volatility that we're likely to get next week, I think, is very much enhanced by the fact that there are bad positions out there, including our own. We never expected the ES to break so hard on the downside. We thought that it would be contained by the 2050 to 2040 area. we were just proved wrong, and this now gives us bad positioning because of our options. Now, we don't think we're alone. We think that there are huge amounts of people who need to still liquidate because nothing got traded between, let's call it 21.35 and 21.20. Very little was traded here. And any kind of bounce towards the 2140 area in ES is going to get sold very hard. We certainly think that the first move is going to be to go and try and test the 2100 area and make people get short at bad levels, then move back up to squeeze them out, and then probably move back down. So we think it's going to be a very volatile week ahead, in which keeping positions smaller is going to pay off, but also one in which being aggressive in the one market which makes sense and has fundamental value, i.e. short fixed income, and especially periphery Europe fixed income, is going to be hugely rewarding. Thank you very much.